We recently helped a client set up a Cypriot holding company, or at least transfer the shares of the UK companies, now the subsidiaries, to Cyprus. We don't ourselves get involved in the Cypriot setup. However, what we do is we put a valuation on the shares and we assisted with the sales process. Now, this involves preparing a J30 stock transfer form, updating the shareholders on Companies House via CSO1 and SHO1, and then finally submitting your stamp duty information to HMRC via email. You have to pay 0.5% on any stamp duty on his share purchases above £1,000. So because this is moving to Cyprus, the client has to have substance there. In this case, they actually reside there. So it makes sense for them to have the holding company in Cyprus and to distribute their subsidiaries globally. Now, because the Cypriot company is now the holding company, you can't use what's called a HMRC clearance. If the group was within the UK, you can apply for clearance and offset any CGT, given the fact that it was forming a wider group structure. Given it's in Cyprus, you can't do that. So we had to do what's called a share valuation. We get a fair market rate share of that valuation and actually sell the shares to the Cypriot holding company, which is what triggers the stamp duty. So there are lots of tax efficient structures done globally, lots of tax efficient structures done just in the UK as well with a group structure. So make sure you're analysing that. As your business is growing, you can't just stay as a sole trader or a one company limited company. You need to expand, evolve, invest, and get the best out of your accounting structure. So have a chat with us or have a chat with your accountant and we're sure we can help.